Today, we're diving into the essentials of capital structure, which is all about understanding how companies fund their growth and operations. We'll explore the role of financial leverage and the different financing alternatives available, like debt and equity, as well as some emerging capital sources that are shaping today's market. It's important to see how these choices impact a company's growth potential, risk profile, and returns to investors. We'll also introduce a practical framework that helps evaluate these capital options in a modern financial context. The focus here is on balancing debt and equity strategically to optimize risk and funding decisions. This sets the foundation for the rest of our discussion. Financial leverage is essentially the use of borrowed money to increase the potential return on equity. When a company takes on debt, it adds that borrowing to its capital structure, aiming to generate returns that exceed the cost of that debt. If the operating returns are higher than the financing costs, leverage amplifies profits for the equity holders. However, it's important to remember that leverage works both ways. It can also magnify losses if those operating returns fall short of the debt expenses. So, while leverage offers a way to boost gains, it also brings increased risk. Understanding how financial leverage fits into your overall financing options is key to making smart decisions about funding your business. Let's talk about financial leverage and the balance between its risks and returns. On the risk side, taking on more debt can magnify losses, especially when cash flow weakens. Fixed interest payments limit flexibility, making it harder to respond to changing conditions. Earnings volatility impacts equity holders more severely, and in stress markets, the pressure to refinance debt increases. Essentially, leverage can turn small operational setbacks into much larger financial challenges. On the return side, when used wisely, leverage can enhance equity returns without the need to issue additional ownership. Debt can accelerate growth faster than relying solely on retained earnings, allowing shareholders to benefit more when projects perform well. Additionally, the tax-deductible nature of interest payments can reduce the effective cost of capital. The key takeaway here is that the goal is not to maximize leverage, but to use it efficiently, balancing the benefits against the potential risks. It's about finding the right level of leverage that supports growth while managing financial stability. Now, let's talk about the different types of financial leverage. First, we have operating leverage, which refers to how fixed costs in a company's operations can amplify the changes in profit when sales fluctuate. Essentially, if sales go up or down, those fixed costs cause the profit to swing more dramatically. Next, financial leverage involves borrowing money. Using debt can increase potential returns because it allows a company to invest more, but also magnifies the downside risk if things don't go as planned. When we combine both operating and financial leverage, we get what's called a degree of combined leverage. This shows the total sensitivity of a company's earnings to changes in sales, considering both the operating fixed costs and the impact of financing choices. Understanding these concepts is crucial for managing risk and decision-making around financing alternatives. When we talk about debt financing, it's important to understand that every debt instrument is defined by four core terms. These terms fundamentally shape the cost, flexibility, and risk involved in the financing. First, we have the principal, which is simply the amount of money borrowed that must be repaid over the life of the loan. This is the baseline figure that everything else in the debt structure revolves around. Next is the interest rate. This represents the cost of borrowing. It can be either fixed or variable, and it's expressed as a percentage of the principal. Essentially, this is how much extra you pay the lender for providing the funds. The third key term is maturity. This is a time horizon until the debt must be fully repaid or refinanced. It tells you how long you have to pay back the principal along with interest. Lastly, we have covenants, which are the rules and restrictions lenders impose. These are designed to protect the lender by ensuring the borrower maintains the capacity to repay the debt. Covenants can influence how flexible you are in managing your business while the loan is active. Understanding these four elements, principal, interest rate, maturity, and covenants, helps to grasp the overall framework of debt financing and how it impacts your financial strategy. Equity financing is a way to raise cash without having to make fixed repayments. Instead, investors gain actual ownership in the company, which means they have a real stake in its future value. When you raise capital through equity, you're essentially selling a permanent share of your business. For example, If you sell 25% equity, that 25% becomes a slice of the company that investors own. This means you share control, earnings, and any future upside. However, one important concept to understand is dilution. Dilution occurs when new shares are issued. It reduces each investor's percentage ownership unless they buy more shares in the new round. Looking at the founder's stake before and after a new round, you might see a decrease from 40% to 30%, even though the founder owns less percentage-wise. This trade-off brings in more cash. This cash can fuel growth without adding debt or requiring interest payments. So the benefit of equity financing is getting more funds to grow your business without any obligation to pay back with interest. The trade-off is you give up some control and voting power as your claim on future returns becomes smaller. Understanding this balance is crucial when deciding how to finance your company. Traditional bank loans are a classic form of structured financing designed around predictable repayment schedules, thorough lender underwriting, and securing the loan against assets or cash flow. One key feature is the fixed terms. The loan amount, interest rate, maturity date, and repayment schedule are all negotiated up front. This setup gives borrowers a clear understanding of their cash flow obligations from the start. Another important aspect is collateral requirements. Banks typically require security in the form of inventory, equipment, receivables, property, or even personal guarantees. This reduces the risk for the lender and helps protect their investment. The approval process is driven heavily by credit assessment, which involves evaluating the borrower's credit history, financial leverage, profitability, coverage ratios, and overall ability to consistently service the debt. Traditional loans are very much relationship-driven, relying on solid documentation, disciplined underwriting, and confidence that the borrower will meet repayment commitments. This approach ties access to capital directly to these fundamentals, setting it apart from other financing alternatives. Let's talk about bond markets and fixed income. Corporate and government bonds raise capital by promising fixed payments over time. So the value of these bonds really hinges on three main factors: income stability, how sensitive they are to interest rate changes, and the quality of the issuer. First, yield represents the return investors expect. Typically, higher yields indicate higher risk, longer maturity, or lower bond prices. So when you see a bond with a high yield, it's usually signaling something about the risk involved. Next is duration, which measures how sensitive a bond's price is to interest rate movements. Bonds with longer durations experience sharper price changes when rates fluctuate, making them more volatile in changing rate environments. Lastly, credit rating reflects the market's perception of the bond issuer's default risk. Strong credit ratings mean lower borrowing costs because investors feel confident the issuer will pay back, whereas weaker ratings require a higher yield premium to compensate for increased risk. In summary, fixed income offers predictable cash flows, but these are always priced against the underlying risk factors: yield, duration, and credit quality. Understanding these elements helps you evaluate and compare bonds effectively. Here we have a comparison between venture capital and private equity, highlighting their core distinctions. Venture capital typically funds companies in their early stages of growth. In exchange, they take a minority ownership stake with potential for significant upside as the company scales. On the other hand, private equity usually buys larger stakes in more mature firms. Their goal is to drive value creation and ultimately exit with a profit. Both share the same ambition of capital growth, but they operate at different stages, with different levels of control and risk. Venture capital is comfortable backing uncertainty and the potential for rapid scale, whereas private equity focuses more on optimizing cash flow and maintaining greater ownership control. Understanding these differences is key to grasping how financial leverage and financing alternatives play out in each scenario. Here, we're looking at crowdfunding and alternative financing, which represent a shift from traditional, concentrated funding negotiations to models that invite broader participation and enable quicker validation in the market. Instead of relying solely on banks, capital is now more distributed, expanding access to a wider range of potential investors. Crowdfunding works by pooling many small contributions from individuals, using platforms that offer rewards, donations, debt, or equity. This makes it possible to raise funds from a large community rather than a few big players. Peer-to-peer lending, on the other hand, connects borrowers directly to lenders through online platforms, bypassing conventional financial institutions. These methods are especially effective for gaining early traction, reaching niche communities, or supporting borrowers who might not qualify for traditional credit. The key takeaway is that capital sourcing has evolved. Now, networks of people and institutions play a pivotal role beyond just conventional banks, offering innovative paths for financing and leveraging financial resources. Let's talk about leverage buyouts, or LBOs. Essentially, an LBO is an acquisition where the buyer uses a significant amount of debt to purchase a company. The first key point is selecting the right acquisition target. Ideally, a company with stable cash flow, since this cash flow will be crucial for servicing the debt. Next, the buyer uses debt financing to fund most of the purchase price, minimizing the initial equity investment. Then, the focus shifts to operational improvements. By increasing margins and boosting cash flow, the buyer can enhance the overall enterprise value of the company. Finally, there's the exit strategy. The goal is to either sell the company or refinance it at a higher valuation, capturing a strong return on the investment. This cycle shows how financial leverage and strategic management can work together to create significant value. The debt to equity ratio is a straightforward way to understand how much of a company's financing comes from creditors compared to its owners. Essentially, this ratio is calculated by dividing total debt by shareholders' equity. A higher debt to equity ratio indicates the company is using more leverage, meaning it relies more on borrowed funds. However, what's considered a healthy ratio really depends on a few factors, like the stability of the company's cash flow and the norms within its industry. For example, asset-heavy sectors, such as utilities and industrial companies, often carry higher debt levels because their revenues are more predictable and they have tangible assets to back up the debt. On the other hand, growth-oriented businesses, especially in tech or early-stage firms, typically prefer lower leverage. This is because their earnings can be more volatile and their assets are often intangible, making it riskier to take on high debt. Ultimately, a healthy debt-to-equity ratio is one the company can manage comfortably through tough times, not just when the market is doing well. It's about sustainable financial leverage and choosing the right mix of debt and equity based on the company's unique situation and financing alternatives. Let's take a closer look at when leverage can actually backfire, using the 2008 credit crisis as a case study. During that time, thin liquidity and heavy debt loads created a perfect storm. A market down wasn't just a dip. It triggered forced asset sales and breaches of debt covenants. This ultimately led to permanent destruction of equity value. One of the key takeaways here is that leverage amplifies losses much more quickly than it does gains. When cash flow problems arise, debt quickly stops being a helpful tool and instead starts driving negative outcomes. Essentially, over-leveraging reduces financial flexibility at precisely the moment when resilience is most crucial. So, the core lesson is that while leverage can boost returns, it also significantly increases risk, especially in times of stress. It's important to understand how financial leverage interacts with financing alternatives to avoid the pitfalls seen in crises like 2008. Here, we're focusing on the interest coverage ratio, a core metric used to assess a company's ability to service its debt. It's calculated by dividing EBIT, or earnings before interest and taxes, by the interest expense. A strong interest coverage ratio means a company has a comfortable earnings cushion, indicating it can easily meet its debt obligations without strain. This generally points to lower concern from lenders. On the other hand, a weak ratio signals tighter cash flexibility. It suggests that operating profits might struggle to cover interest costs, increasing financial risk. Importantly, a falling ratio can be just as alarming as a low ratio itself, often serving as an early warning sign of liquidity stress before more serious financial problems emerge. When the ratio dips below 1.5 times, it's considered a danger zone. Coverage this low often points to rising default pressure, signaling urgent attention is needed to manage financial leverage or explore alternative financing options. Understanding this metric helps us gauge overall debt service capacity and anticipate potential challenges. When it comes to choosing the right financing mix, several key decision factors come into play. First, let's consider the growth stage of the business. Early ventures typically prize flexibility because their cash flows are unpredictable, so they often prefer financing options that don't lock them into rigid repayment schedules. On the other hand, mature firms with stable cash flows can support more structured forms of debt. Next, tax implications are crucial. Interest on debt is often tax deductible, which can lower the after-tax cost of borrowing. However, this benefit only matters if the company has reliable cash flow to meet interest payments consistently. Finally, consider the cost of capital. It's important to compare the true price of different financing options, whether debt, equity, or hybrid instruments, and weigh these costs against the expected returns of the business. Balancing financial leverage and alternative financing sources thoughtfully can help optimize the capital structure for growth and sustainability. Let's talk about the cost of capital and how the weighted average cost of capital, or WACC, plays a central role in funding a business. WACC represents the blended price a company pays to raise funds from both debt and equity sources. First, the cost of debt is essentially the interest rate paid to lenders, but it's important to remember this rate is adjusted for the tax shield, which effectively lowers the after-tax borrowing cost. Next, the cost of equity reflects the return that investors expect for taking on ownership risk. This is typically higher than the cost of debt because equity investors face more uncertainty compared to lenders. Now, the weights refer to proportion each source of capital contributes to the total financing mix. The capital structure, meaning the balance between debt and equity, drives the weighted blend we calculate as WACC. The core idea here is that incorporating more low-cost capital, like debt with tax benefits, can reduce the overall WACC. However, taking on additional risk, whether through more debt or higher equity demands, generally pushes the cost of capital higher. Understanding and managing these components is crucial for making informed financial decisions and optimizing the company's value. Let's talk about the tax implications of debt and why it matters when companies decide how to finance their operations. One key point is that debt can lower taxable income because the interest expense on debt is usually deductible. This means that borrowing money can actually reduce the after-tax cost of financing, making debt a potentially cheaper option compared to equity. However, it's important to note that principal repayments are not deductible. Only the interest portion provides a tax benefit. This creates what's called a tax shield. Essentially, every dollar of interest expense shields some of the company's earnings from taxation. The size of this shield is calculated by multiplying the interest expense by the tax rate. Understanding this tax shield is crucial because it impacts the overall cost of capital and the financial leverage a company might use when choosing between different financing alternatives. So, the tax advantage of debt should always be considered when evaluating the best financing strategy. Let's talk about how leverage norms vary across different sectors and why these differences exist. First, leverage tolerance depends largely on factors like the stability of cash flows, the nature of the asset base, and industry regulations. For example, in the utility sector, high leverage is quite common. This is because utilities generate very predictable cash flows, and their assets tend to be long-lived, making it easier to manage and service debt. On the other hand, tech companies typically maintain low leverage. These growth-oriented firms favor equity financing and value flexibility over taking on fixed debt obligations, since their cash flows can be more volatile and uncertain. Retail businesses tend to have moderate leverage, but this can vary depending on factors like the company's scale, inventory cycles, and how volatile consumer demand is. It's a balancing act between managing working capital needs and financial risk. Manufacturing firms usually carry moderate to high leverage. This is often due to their asset-heavy operations and significant capital expenditure requirements, which lead them to rely more on debt to finance their equipment and facilities. Lastly, the finance sector operates with very high leverage structurally. However, this leverage is tightly regulated through capital and liquidity requirements to ensure stability in the financial system. Understanding these sector-specific leverage norms helps us appreciate why companies in different industries take on varying levels of debt. It's all about matching financial strategy to the unique characteristics and risks inherent to each sector. Refinancing risk tends to build up when a company has a large amount of debt coming due all at once. This situation creates pressure because a company needs to secure new funding or roll over its existing obligations within a limited time frame. When there's a maturity mismatch, meaning short-term debts need to be refinanced before long-term cash flows are available, the risk is even greater. To manage this, companies aim to stagger their debt maturities over time. By spreading out repayment dates, they reduce the exposure to risks like tighter credit markets, higher interest rates, or limited access to financing. It's important to understand that the term structure of debt, how the maturities are distributed over time, matters just as much as the total amount of debt a company carries. This staggered schedule is a core discipline in financial management. Looking at this illustrated maturity schedule, we can see that the highest refinancing pressure falls around 2028 and 2029, where a large portion of the debt reaches maturity. If the market tightens during this window, the company might face refinancing at higher costs or under more restrictive terms, which could strain its financial flexibility. Finally, it's worth noting the breakdown of different debt instruments involved, ranging from revolvers and term loans to senior notes, bond issues, lease debt, and convertible instruments, all maturing across various years from 2026 through 2031. Managing this diverse mix with a well-structured timeline is essential to maintaining financial stability and minimizing refinancing risks. Let's talk about covenants and restrictions, which are crucial elements in lending agreements. Financial covenants set specific numeric performance limits that borrowers must meet, such as maintaining an interest coverage ratio above 3.0 times or keeping debt ratios below certain agreed thresholds. These limits are designed to ensure the borrower remains financially healthy and capable of repaying the loan. Operational covenants, on the other hand, focus on limiting certain actions and how assets can be used. For example, borrowers might need approval before selling major assets, face restrictions on paying dividends, or be limited in taking on new debt. Together, these covenants and restrictions serve a common purpose: to protect lenders by clearly defining measurable boundaries on risk. By enforcing these rules, lenders can better manage financial leverage and explore financing alternatives with greater confidence. When we talk about capital structure hierarchy, it's important to understand the order in which different types of financing are repaid. At the top of the hierarchy, we have senior debt. This has the highest priority, meaning senior lenders are paid first, which makes this type of debt the lowest risk. Because of this lower risk, senior debt often comes with more favorable pricing for the borrower. Next in line is subordinated debt. This debt is paid only after the senior debt has been fully repaid, which increases its risk compared to senior debt. As a result, subordinated debt usually carries higher interest rates to compensate for that added risk. Finally, at the bottom of the hierarchy, there is equity. Equity holders have a residual claim, meaning they are the last to be paid and face the highest risk. However, this also means they have the greatest potential for reward if the company performs well. Understanding this repayment priority is crucial because it directly impacts the risk, pricing, and who ultimately gets paid first in any financial structure. This hierarchy helps companies and investors make informed decisions about their financing alternatives and the level of financial leverage they are comfortable with. As capital markets evolve, we're seeing a range of emerging financing alternatives that go beyond traditional debt and equity. One notable option is Islamic finance, which uses asset-backed and profit-sharing structures. This approach not only provides access to capital, but also aligns closely with Sharia principles, offering a unique financing pathway. Another important development is ESG bonds. These allow investors to finance issuers who commit to specific environmental, social, and governance goals, creating a direct link between funding and measurable positive impact. Green financing is also on the rise, where loans and bond proceeds are specifically tied to projects in renewable energy, energy efficiency, and sustainable infrastructure. This not only supports climate goals, but also attracts investors focused on sustainability. Lastly, purpose-linked capital introduces new financial instruments where funding terms are connected to impact, transparency, and stakeholder expectations. This shift reflects a broader market trend toward embedding purpose and accountability into capital structures. Overall, the market is shifting to include more purposeful, impact-driven financing options, expanding the possibilities for both investors and issuers. Here, we're looking at the core components of the risk assessment framework when considering financial leverage. First, liquidity risk is about making sure there's enough cash on hand to cover short-term obligations as they come due. If you don't have this liquidity, you could face serious operational issues. Next is default risk. This happens when earnings or asset values drop below what's needed to pay back debt, which can jeopardize the entire financial structure. Then we have market risk, which involves changes in interest rates, spreads, or valuations that can increase financing costs and put pressure on returns. Finally, refinancing risk occurs when maturing debt must be replaced in capital markets that are less favorable or harder to access, which can limit financial flexibility. It's important to stress test cash flow before deciding to add leverage. Making disciplined decisions around leverage means evaluating all these risks together rather than looking at any one in isolation. That comprehensive view helps ensure the organization stays financially healthy. Here, we focus on strategic debt reduction, which is all about deleveraging through a disciplined sequence: repay, reshape, and then grow into a safer capital structure. First, we prioritize debt paydown by directing free cash flow toward the highest cost or soonest maturing obligations. This helps lower our overall interest burden effectively. Next, we look at asset sales. By monetizing non-core assets, we can accelerate deleveraging without compromising our strategic capacity. This allows us to unlock cash quickly and strengthen our financial position. Finally, we drive EBITDA growth by expanding earnings through improved pricing, product mix, and operational efficiency. This organic growth is key to improving our leverage ratios and strengthening coverage ratios over time. Together, these steps form a comprehensive approach to managing financial leverage and exploring financing alternatives that support long-term stability. To wrap up, let's focus on the key takeaways. First, remember that leverage is a tool, not a goal in itself. It's something you use strategically, not something pursued blindly. Next, it's important to optimize your debt equity mix to balance risk and return effectively. Understanding the norms within your industry helps you set realistic and competitive leverage targets. Keep a close eye on covenant compliance to avoid any breaches that could lead to serious consequences. Lastly, plan early for refinancing risk to ensure you're prepared when it's time to renew or replace your debt. These principles are essential for managing financial leverage wisely and making informed financing decisions.